Just in terms of time frames, I have a number of people who come to me over the years who have purchased an asset. It's been purchased after CGT coming in, so it's been bought after the 20th of September 2015, so CGT is applicable. They've held it for longer than 12 months, so the CGT discounting applies, so 50% discounting. But then they've sold the asset very close to, so they're employed, they've sold the asset very close to the 30th of June and then say, oh, we're going to have this big tax bill, what should I do about it? And because with salary sacrifice, you can only salary sacrifice into the future. So if you decide in June that you want to try and reduce your tax by salary sacrificing to super, and all you've got left of, because it is June, is your one payment for June, the maximum salary sacrifice you could actually take advantage of is your 100% of your salary in June, whatever that figure is. So it just means that there's limited income that you can contribute if you're selling just before the contract date is just before the 30th of June. So you can sell the asset close to the 30th of June, but the ideal scenario would be that if you've actually planned that ahead of time and you've got a lot longer period to actually salary sacrifice into superannuation. So say, for example, you've sold the asset here or the contract date for the asset and you've received a deposit of 10% in July, for example, then you've got the rest of the financial year to salary sacrifice all of that income up until the 30th of June. So you could almost salary sacrifice 100% of your income, or not 100% of your income, but if your income, say, $35,000 and you're over 50, you could salary sacrifice, around $30,000 and reduce your tax effectively like that. So just in time frames with salary sacrifice, you just need to plan ahead. If that's the only way that you can reduce the capital gain, then you just need to plan for it ahead so you can actually implement the salary sacrifice strategy.